I do several a week. So
Yeah, and what we can do is if you if there are no questions prompted,
mhm.
that folks are asking, I'll keep an eye on the chat. And
Yep,
those of you who are listening now, you might want to type questions into the chat as we go along, as Brian goes through what he has to share with us today, because that'd be a great way to get the conversation started. Um, so we're going to give people a minute or so to get settled. That's what we usually do. And I'm going to try not to break anything in my producer's studio here. I'm not surprised he's not looking in the window over there. Make sure I'm not fiddling with the knobs. We'll get started in a minute here. Get giving time for everybody to get situated. I've got coffee. Should drink it this way. And we'll turn things over to Brian as soon as he sits back down. Thanks everybody for taking time out of the middle of the day. I know that that everyone's busy. We will send a replay link out to everyone who registered for this. So in the future, it's not a by appointment type thing. You will get a replay link of this. So I think what we'll do is get started, and I think what I have to do here is we're going to talk about something that a lot of people ask questions about. I've done 2 events this week. I did 2 last week, and the question of UBIT and UDFI always come up. And there are a lot of products out there that claim to have UBIT blockers and things like that, and it's kind of a little bit voodoo to a lot of us, myself included. So we're really glad to have Brian Fine come in and talk to us about it. He's been investing, for over a decade. In the past decade, he's built this huge portfolio of cash flowing rentals. He's got hundreds of rentals now, and he's out helping other people do what he does and build their own, portfolio. So uh, we've asked him to come in and share the latest on what he's doing and about avoiding UBIT. So I'm going to try to go to the next slide here. And yeah, we have to do a disclosure. We have to do the heretofores and notwithstandings. And basically, we're just a neutral party. We're the registrar, custodian, administrator of your account. We don't make any recommendations. We invite speakers over here because it's an educational mission for us. And of course, happy to have them. But you need to follow up and do your own due diligence with our speakers. We don't accept any liability for losses and damage, et cetera, for doing any of the things that you see on here. And we always say to get your CPA and get your tax advisor, and if necessary, your lawyers involved in anything you do. Self-direction is self-directed. So without any further ado, I think there's one more slide and then we'll back off of that. And I think I do the unshare, and then Brian's going to take over. Brian, yeah, we're really glad to have you here, and see if I can figure out how to do this.
looks like I can share just fine, Joe.
Okay, you
Thank
got
you.
it.
So let's see. 1 second here, and you tell me whether or not you can see this. You see that?
I see it. All right, we're ready.
Cool.
It's overcoming my technological handicap here. Okay,
Cool.
go for it.
All right. So, everybody, it's great to be here. Uh, very thankful to Joe and Camoplan for asking us to take part. Um, and I've been investing for a little over a decade. We've built a portfolio of rental assets in Pittsburgh, it's several hundred units, and we buy them, we fix them, we sell them, we trade these things like they're baseball cards. And I fund these millions and millions of dollars of transaction using private capital. And primarily that comes from folks like yourselves who have self-directed retirement accounts. And one of the big appeals of doing that is not just the relatively reduced risk compared to other things like stock investments and bonds and that sort of thing, but that we have ways of getting some pretty phenomenal returns and various tax benefits. And normally, the IRS frowns pretty heavily on us double dipping. Your retirement account is already a tax shelter. They don't like seeing additional benefits in there. So we have to follow some very specific rules that they've given us, but they've really like real estate and they like us providing homes to people. And so the tax code allows quite a bit of freedom in the real estate industry to make this stuff work. And as investors, whether it's a debt position lender in mortgages like you guys are probably going to do, or as a direct investor like myself, the IRS gives us some substantial benefits for playing that game. So today we'll talk about some of those, and I'll give you some neat ways that we put it together. And then we will talk about there's a common thing that people want to do in real estate out of a self-directed retirement account, and it triggers UBIT. There is a way, completely legal, challenged by the IRS around it. So I'll take you through what that structure is so you guys are aware it exists. So let's get started. And Joe, if you would keep an eye on the Q&A for me and let me know if I miss anything as I'm going, okay? And you guys can interrupt me with questions at any moment. I'm fine with it, and I'll have some time at the end. All right, so first, I've already talked about me. Uh, when I started out, I was a house flipper. I bought them, I fixed them, I sold them to individual owner occupants. And then after we did that a hundred or so times, we started moving into holding the property. So now it's all about buy the property, hold the property, rent the property. We still flip homes. We do it several times a month, but ultimately the goal is to build that large long-term portfolio. Because just like you, I'm looking for those returns on a recurring basis that surpass inflation and give us effectively ongoing wealth well into retirement. All right, quick agenda for you. It'll be easy. We're going to talk about mortgages, or from the point of view of the actual lender, it's a MBS, a mortgage-backed security. So we'll talk about those. We'll talk about the risk management because a private mortgage is just that, is private. And as a self-directed investor, you are in charge of your own world. So I'll give you the point of view of the borrower as somebody who, takes a couple $1 million a quarter of this stuff. We'll talk about the tax implications here and what that piece looks like as well. And it's really not that deep or complicated, at least from the mortgage point of view. All right, let's start with, are you a lender? Is this a thing you even want to do? Well, do you want a great return backed by real estate? Meaning if the loan is not paid back according to the terms you've negotiated, you can take a piece of real estate and use that to recover your losses. If so, then you are probably going to be a mortgage lender. It's a fairly attractive way to do things. If I was to buy into a stock and that stock became worthless the next day, I'm not going to go get to recover assets from the company whose stock just went down in order to recover my losses. I'm just stuck with them. But in the case of real estate, it's a legal term, real, as in actually exists, estate, actual asset. So these things still exist. Even if they burn down, they're insured and you're paid that way as well. And so it is a investment that is backed by a hard asset. And in that way, it is more attractive than many of the other vehicles you'll find out there. Where are the funds coming from? I'm going to use the assumption today that you guys are talking about self-directed retirement accounts, but those funds can come from anywhere. That can be like home equity lines of credits, money in a checking account, whatever it is, it all works. Any place you can get money that you're allowed to send somewhere is capable of funding a mortgage. How long of an investment can you make? I'm sure you guys have all gone through the retirement planning stuff where they talk about your time horizons and those sorts of things. Depending on your age, whether or not you're actively tapping into these accounts yet, those are going to determine how long you want these mortgages to last. Generally, they're going to go more than a year. You can get a few that are shorter than a year, but typically you're looking at a 12-month or longer type investment. So that is something to consider as we're looking at these things. What kind of a timeline do you guys want? Longer terms are beneficial to both the borrower and the lender. That is because the borrower ends up with a nice secure position. They don't have to worry about the money on the asset, and they have more time to make it worth more, because real estate tends to go up in value over time. And as a lender, you're generally charging simple interest, and the longer that goes, the more interest we make. So we don't want the money back, because as soon as it's sitting back in our account, it's unemployed money and it's sitting there bleeding inflation. Shorter terms are typically higher risk. So there are such thing as short-term notes. On occasion, I'll do types of transactions where I would only need your money for maximum 90 days. There are risks associated with that. And so if you're going to get into those kind of things, the returns are much higher for the amount of time you're doing it, but you're going to want to understand what ways those things could go bad, and you could end up losing principal over that. So it's just a risk reward thing. The longer ones are generally safer, shorter ones less so. How much is available to invest? This is going to very carefully, heavily color what you guys are doing in the real estate world. If you only want to invest in Southern California, for example, I hope you have more than $1 million. If not, then it's going to be very hard for you to have enough capital to do much of anything in a market like that. So if we're talking about tens of thousands to hundreds of thousands, then you're going to be looking at the Northeast to the Midwest. I'm out of Pittsburgh. We tend to be on the more affordable side of things, so we're able to take smaller dollar amounts. So how much you have is going to determine the kind of market you're going to end up in. When can you close? Working with self-directed retirement accounts is usually pretty painless. Once we get together the necessary paperwork and you guys get over your direction form, most custodians are going to fund these things in just a few days. So it's a very, very nimble type of investment vehicle. And then how do you want or need paid back? This varies depending on the fund source, but do you need monthly payments, or will you take payments later on different terms? And there's various reasons to get into not taking monthly payments. The default is you're going to get paid monthly, just like any bank would expect a monthly payment, but there's plenty of ways we can structure it. And because it's a private mortgage and a private negotiation between free-willing capitalists, we can basically structure whatever we want. So we'll talk a little bit today about what some different terms and some different ways we might do things and why that might be appealing. All right, so let's talk about mortgages in just a little bit more detail here so we're clear about them. So a mortgage is a loan. The formal name for a loan is a note, where real estate is put up as collateral securing the position. So you can make an unsecured business loan or an unsecured personal loan. You can just lend Brian $100,000, and I can give you a personal guarantee that I will pay you back. In the event that I don't, you can take that personal guarantee and your note, hand it to a lawyer, and they can go get a civil judgment against me to pay you that money, and they can try to collect it. If instead you're going to lend that $100,000 on a piece of real estate, then if that note is defaulted on, you'll hand your lawyer that note, you'll hand them the mortgage, they'll go record the default, and following whatever procedure the state you're investing in has in question, you're going to end up with that property, which you can now turn around and keep for yourself, sell, whatever it is you want to do. Most lenders will turn around and liquidate them to recover any losses. All right. And that's in the lawsuit. To do that is called a foreclosure. The procedure for a foreclosure varies by state. So depending on the state you're in, that can be relatively easy and painless to you never ever want to do it if you can possibly avoid it. All right. The security on notes, there's a couple of different ways they're structured. There's a thing called common equity. This is where you own a percentage of the property. So if I'm going to buy a house, you're going to help me fund it. I own half the house, you own half the house. 50-50 is just a simple example. Terrible idea to do 50-50, but it's illustrative enough for this purpose. All right. This is a bit of a no-no with retirement accounts. We're going to want to avoid this one. You don't want true ownership. That's when we get into UBIT. A promissory note. This is unsecured debt. This is where you just lend somebody or some business capital. You are free to do that. That is totally cool. There's even reasons you might do that. One of the more common places that I use unsecured promissory notes is with your kids. So I'll have a lender who's working with us on mortgages, and then they'll say, "Hey, my 8-year-old has $8,000 in a Roth that we put together for him. Is there anything you can do with that?" Simple answer is no. I can't do much with 8 grand. It's too small. But we can kind of tag it onto yours, sort of, and I'll take it as an unsecured loan as a separate. We can't give them a mortgage because the dollar amount's too small. But that's an example of a simple promissory note. Senior debt is a first position mortgage. So you'll hear the term position used with mortgages: first position, second position, third, fourth, fifth. And it's a very literal thing. It's the order in which the mortgage is recorded at the county. And in the event of a foreclosure, the way it's going to go is whoever's in first position gets to take the property first. They get first right of refusal on everything. They can choose to buy it and that. Those in second, and hopefully there isn't thirds and fourths. Those are positions you guys want to avoid. Seconds are great. Thirds and fourths I would shy away from. They get pretty risky. Whoever's in second would get the option to buy out the first. That's how that works. First position is usually a bank, or in the event that it's you, it means you funded the whole deal. First position is basically writing the biggest check. Second position is what we call subordinate debt. So let's say I go to a bank and the bank gives me 75% of the purchase price of a property. Well, I still need that other 25. If I come to a private lender and say, okay, can I have that 25%? And we come to an agreement on that, then that 25% will be recorded as a loan in second position behind the first 75%. Preferred equity. This is a structure by which instead of a mortgage, you're going to get equity in the property. And that equity, it's really just collateral. In the event that there's a default, instead of going through a foreclosure, you just take the rest of the equity. So as a simple example, let's say I'm going to buy a house for $100,000 and you're going to lend me $100,000. The way that would work is I would give you, instead of recording a mortgage on it, I would take 1%, I would give you 1%, or your retirement account, 1% ownership in that LLC that owns that property, and I keep 99. In the operating agreement, we would put what we call a pledge agreement that says, as long as you're paid back according to the terms of your note, whatever they are, you get your payments and got your interest and everything, we're all happy and everything is right with the world. But in the event of a default, I pledge my 99% of equity against the note. And so instead of a foreclosure as a closed business function within our LLC, you immediately become 100% owner of the entity that owns the property. No foreclosure, no court, no judgment, works in all 50 states. So it's a very sexy way to do it. It's not always an option. I can tell you guys that when I do these usually are larger. I'm gonna typically do these on portfolios, properties, and entities worth over $500,000. I'm not going to get into this with a $50,000 house. But these are a very, very attractive structure. They work quite well. I see a question. I have a confession of judgment in my paperwork. Do you include a confession of judgment? Yes. There's standard documentation you're going to want to use in pretty much every state. Confession of judgment is one. It's all it really says is that in the event that a default is proven, you're not going to try to claim that it wasn't a default. That's really all it does. It's just part of what gets filed with the county as part of your foreclosure lawsuit. And the exact way that work, again, heavily varies by state. So you'll want to understand the state's foreclosure process that you're investing in, and kind of get through that and understand what that would look like as far as your risk goes. All right. Here's some examples of just structures. And I, I realized after I made this that it's probably far more confusing than I meant it to be. So I won't spend a lot of time here. Uh, look at it vertically. So just straight up and down. Actually, hold on. Might let me draw. Cool. Can I draw? Yeah, I can draw. Okay. So if I have a business or money partner, then these are all the things we can do. If I have a senior debt lender with a first position mortgage, then these are the things we can do, but they can't do the things in red. So a senior debt person does not get a profit or equity share. They could do all the rest of this stuff, though. An unsecured note doesn't get a profit or equity share, but it can do all this other stuff. Preferred equity, which is the one I talked about, where instead of a mortgage, you're just going to get that little piece of equity in there, and you'll take the entity in the event of a default. It can do everything. It's one of the more flexible setups we have. And then a second position mortgage, same thing. So it just gives you an idea, depending on what security you use, what options are available. So again, I apologize. After I made this, I was like, wow, this is not nearly as simple as I wanted it to be. All right. Oh, wait. Now how do I make them all go away? That made it worse. Let's see.
This is usually what happens to me, Brian.
There we
So
go. Okay, I
there
found an
you
undo
go.
button. That's close enough. Cool. We'll take
That
it.
was a great chart, Brian. I don't know if anybody else listening would want to have that chart, but if you send it to me, I'll send it to, if you're willing
Yeah.
to share it, I'll send it to everybody that's signed up for this thing. So I think that's excellent. Thank
Yep.
you.
So, and this was my round two at it. This was meant to be a lot simpler. So if you want to do some lending, great. We want to be a lender. And we're using retirement of funds, which I assume most of the people on this call, that is your thing. Then these are the three structures that we would use. We already talked about mortgages, first or second position. That's fine. We already talked about preferred equity. And then we're going to talk about the SAM, the shared appreciation mortgage. We'll talk about that one in a minute. For all other funds, you can do all the same stuff, except they can also be a business partner. They can take common equity in the asset. If you try to take common equity in your retirement account, this is where we run into places that we don't love as much because now your retirement account owns part of the property. And while it is totally possible and legal for you to buy rental assets or just general real estate, like for flip or something in your retirement account, uh, it, it's messier. It's quite a bit messier, and we risk triggering things like UBIT and generally making your accountant not like you very much. So typically, from a debt point of view in retirement accounts, we're going to want to stay away from that joint venture type structure. It's just not as attractive given the rules around self-directeds. Just because you can do it doesn't mean you should. Okay. Oh, come on. There we go. All right, so let's talk about your returns a little bit. The way I like to talk about returns is that risk and reward are a law of nature. The higher your risk, the higher your reward, and vice versa. So this is just a short list of things that a real estate borrower will ask you to do. And for every one they add, that adds to your risk as a lender, and thus you should be getting a higher interest rate. First one is to bring 100% financing. I can tell you guys right now that is my default mode. If I am paying $100,000 for a property, I expect a $100,000 loan. That is how we do it. Fast close. Less than 2 weeks. I need this money by next week. We gotta do this very fast. That reduces the amount of time you have for due diligence and that sort of thing, and essentially creates a higher risk environment for you. Second position or preferred equity when there is a senior position, as in we got a bank. Somebody else is a lender on this deal and they've written a bigger check than you. That is inherently higher risk than if you were the top lender or the only lender on the project. And so that's worth a higher return as well. Short-term loans, anything that lasts shorter than 6 to 12 months. If I'm doing a rehab loan, which is a fix and flip, we usually write those for a year and I'm done in 6 to 8 months. That's about as short a term as you're going to get before the risk increases. We have certain versions of this where we'll do 90-day money and things like that. That is inherently higher risk and carries a higher reward per capita for that. Light to medium construction. So there's no construction. That's not an increase in risk. And then we got a little bit of construction. And then we have a lot of construction. What I consider a lot of construction, the term we use in my industry, is an upside down renovation. That is where the amount of money we're spending on renovations surpasses the cost of buying the property. So it is a higher risk to me to spend $50,000 on a house and $100,000 fixing it than it is to spend $100,000 on a house and spend $50,000 fixing it. And so if I'm a lender, I want to hear that you paid more for the house and you're spending less on that renovation because that renovation is where the capital is at risk. That's where we might have problems. If I paid $100,000 for it, it's probably worth $100,000. Paid $50,000 for it and I gave somebody another 100, well then I'm counting on the project to make that house worth another 100. So it's just more exposure for us. So a little bit of construction is okay. A lot of construction is higher risk and generally contains a higher interest rate because of it. And delayed payments. If you want paid every single month, that is fine. That is kind of default mode. But we'll talk in a few minutes here. There are lots of reasons why not to take monthly payments, especially if you're in a situation where this is retirement capital and you're not touching it anyway. So it doesn't necessarily have a direct influence on your lifestyle, whether or not this is paid back quickly. So that can be, you're taking a risk, of course, that you're not seeing those monthly payments, but there might be a benefit that offsets that. All right, so here's an example of the lowest risk type of uh, real estate mortgage you would go ahead and get into. This would be a first position mortgage at 50 to 100% the value of the asset. You take 30 days or so to close, just like a standard house. You're going to be receiving monthly payments on this, just like a bank. There's no construction budget, or if there is a construction budget, it's not very high. Definitely a lot less than the purchase price. But then you got to look, what's the reward on that? Well, you've just told me you're a bank because 1 through 5 are what the bank does. And so your reward will not be higher than what I would pay JP Morgan. Why should it be? You're using the same risk mitigation they are. And so you're no more appealing to me as a borrower than Chase. I hope that makes good sense to everybody. Low risk, low reward. All right, let's look at the opposite end of that spectrum. This would be preferred equity or an unsecured project, as in theory, they're using the money for real estate. You can't be 100% sure. You just wired it to an LLC. You're going to do gap financing, meaning there's another lender involved, but up to 105% the value of the asset. You're going to close now. Like, I call you today and I need this money by noon tomorrow. Upside down reno, construction's more than the purchase price. We're going to buy it for 30 grand. We're going to put in 200. It's going to be worth a lot. And zero coupon, which is the term for there's no payments until the loan closes. That would be what we consider the highest risk profile for a mortgage. You better have a real good trust relationship, know who that borrower is. Hopefully you've done a lot of substantially less risky deals with them. Otherwise, yes, you can demand top dollar for this. It's basically whatever they can afford to pay you, you can take. But the chances of something going wrong are much higher than we would see with other structures. Between these two extremes, the low risk, low reward, and extremely high risk, high reward, there might be a pretty good sweet spot. And it may look something like this. You can do it in preferred equity or second position. That has to do with exposure. I don't have to put as much money out to get into the deal as if I was a first position. We don't mind doing the gap financing. That's not too big of a deal. We're going to close on a commercial timeline. This is an investment deal, not a owner-occupant deal. So 30, 60, 90 days, whatever. But it's not closing immediately. We got lots of time to do our due diligence, make sure everything's okay. We're going to do either no renovations or really small stuff. Typically in rental world, that means I'm doing basic turnovers, paint and carpet and things like that. I'm spending a few $1,000s, not a few tens and tens of thousands. We're going to balloon this loan in about 60 months. 5 years is a pretty good lifespan for these. Gives you a nice 5-year interest payment. We're going to do delayed payments, and we're going to give you a bonus at the end when the deal closes. Right? So we'll talk about that kicker at the end a little more here in the next few minutes. If you don't need paid right away, this depends on where you're at in your own timeline with your retirement, right? If you're already to the point where you're drawing upon it and using it for living, this is a different story. Now it's directly income for your lifestyle. If you're not quite there yet, we're still working, we're still doing other things, then you may not need paid right away. And that opens a few doors for you to get some maybe better returns. So if we delay payments for 12 to 24 months, and this is assuming a 5-year loan, it makes it a lot easier for investors like me to do things. And because rent goes up year over year and the value of the property goes up year over year, I can actually afford to pay more. And so if you make it cheap for me up front, then you can make it nasty for me later and I can still afford it. We can capitalize the interest for the period of non-payment. And I'll give an example of this in a minute. Basically, this is the thing in the news that you hear everybody complaining about with student loans. They take the unpaid interest and they add it to the principal. That is totally 100% acceptable. We're allowed to do it. For example, if I borrowed $100,000 from you at 8% and we did no payments for 24 months, so during that 24 months, I would have accrued $16,000 in interest. I'd take that 16K and I add it to the principal. So on month 25, when I'm start making interest payments to you, I'm going to be paying 8% not on $100,000, but on $116,000. That gets you an extra $1,280 per year after year 2. So we got 3 years of that coming in. And after the 5 years, you'll have made a total of $43,840 in simple interest. That's an average return of 8.76% over the 5 years. So by capitalizing the loan after 24 months, we made another 3/4 of a point. And of course, you guys can play with the numbers there and do your own math on it, but that gets you the idea. Preferred equity is better with these because what we'll do a lot of times over that 5-year period is I'll replace the institutional guy in the first position. And if you're in second position, then I actually have to call you, figure out how to pay you back for a minute, and then have you send the money right back. So we actually have to do a new loan. If it's preferred equity, we can let it stand. We don't have to move it or close out the books. So it's a more attractive way to structure these.
Ryan, if I could add one more thing
Mhm.
for delaying payments is that when you're operating these things in and out of your IRA, there are transaction fees associated with payments. So if you don't need to have the interest payments monthly, perhaps you could make them quarterly. Perhaps you could do it structured the way that you see here on this screen. It's much better from a fee standpoint as well.
Yep, absolutely. And those fees may not be very large, but they do add up, and they're taking a little nibble out of your payments.
Yes. At $10 a transaction over a 5-year period, it's
Yep.
it's a dinner out.
And I'll add in just a little devil's advocate on that part too. If it's a cash flowing rental property for me, especially a larger one, like if we're doing a multifamily or something where the loan would be bigger, like $1 million instead of 100,000 kind of thing, then I'm going to prefer monthly payments because I don't want to be in a situation where I got to pay you quarterly this giant check. And if something goes wrong, I got to go looking at a lot more couch cushions to find that money. Whereas if I'm paying every month, even if like tenants didn't pay me or something, it's easier for us to make sure that payment is made. So the larger the loan, the more I lean towards that, unless we're delaying it all the way till the end. So it is a negotiation, and it is both beneficial and harmful to both parties to go too far in either direction. So it depends a little on the project. All right, so let's talk about the SAM, the shared appreciation mortgage. This is a very sexy tool when it comes to investing out of a retirement account. So this is the definition, if you just Googled it, is when a borrower or purchaser of a property shares a percentage of the appreciation and the home's value with the lender. In return for this additional compensation, the lender agrees to charge an interest rate that is well below the prevailing market interest rate. So your monthly interest is going to be really freaking cheap, way below what I'm getting from a bank. It ain't going to be free, but it's going to be real low. IRS case law determined, I believe in 2022, I think 2021, 2022, that this is not considered a joint venture and is not subject to UBIT. So it's a great way to get higher return on your retirements. So somebody did one of these. I believe it was a really high dollar amount one, 10 million bucks out of a Roth, I think. And the IRS decided to call that because that's a big marker for them. They can get a lot of cash if they UBIT that. They took it to court and they lost. And they lost pretty handily. And it was determined that that was actually considered an interest payment, which is kind of cool. It was structured directly into the note. These notes need to be done correctly. So you're either going to need a borrower who's done this before, hi, or your attorneys who know what they're up to as far as the particular state to get it structured right. Okay, make sure they check the necessary boxes to get a legitimate shared appreciation mortgage. Just putting a line in there that say you get some of the appreciation on the closeout of the deal is not going to do it. There, the IRS had I think it was a 5-point test within the note itself that has to be passed. So make sure that your paperwork has what is required in order to please them so that you guys are completely safe doing these transactions. All right. To make it really great, the interest rate doesn't have to be fixed. It could be a percentage of the cash flow after expenses quarterly. And this, again, can make it very, very attractive for your buyer to be picking up an asset that actually doesn't cash flow very well, but is a really solid asset in a good area. And so you can end up with some really good collateral as part of that. Don't worry, they can't negative pay you. That doesn't work that way. I didn't make money this month. I'm going to need another check. That's usually not how those are structured. All right. So as an example, let's say we agreed to a 30% shared appreciation mortgage. We did $100,000, and after 5 years, that property's worth 150 grand. The lender will get 30% of that new 50K valuation, or that's $15,000 at closing, plus any interest that was accrued during that time, according to the agreement. All right, so here's an example of what that might look like with some numbers thrown in for you guys. We have $1 million asset with negligible renovations. In my world, this is probably a 5-unit multifamily. We have a bank in there, and they paid 75% of the whole thing. Doesn't really matter who the bank is. They aren't important. We closed on a commercial timeline of 90 days. And we got a preferred equity loan of 25% plus the closing costs. So one of you is into this deal with us for $300,000. We have a 60-month balloon on this asset. You're going to give me no payments for 24 months. So I got the first 2 years to make sure that this thing is behaving just the way it needs to. I don't got to worry about you. You've given me time. I just got to pay the bank. I got to pay my taxes and insurance, and I got to make sure the tenants are paying their rent so I can handle, we call it stabilization. Raising the rents, getting people in there, doing whatever has to happen to make that rental asset perform. After that 24 months, we're going to go ahead and capitalize your interest. All right, so you're going to get another $42,000 in interest. That's a 7% interest rate, by the way. That's how I calculated that. And then I'm going to pay you 7% simple interest in years 3 through 5. And you're going to get 30% of the new appreciation. So assuming after 5 years it's worth 50% more, so $1.5 million valuation, you're going to get 150,000 additional dollars at closing. So you're going to get back your 300 grand, 342 actually, plus any interest you were paid for that next couple of years, plus an additional $150,000 check at closing. So your total returns are about $263,000, or an average of 17.5% annual interest payment. Far higher than anything we would even discuss paying you in a simple mortgage. Couldn't even look at it. Absolutely not even a question. You come to me and say you want 14, 15%, we're done talking. That's not happening. It's too high. But with a structure like this, we can make it happen. These things can work out for you. Even at half the appreciation, so let's say it only became worth 1.25, so you only got 75,000 at the end. That's still a 12.5% return. I don't know about you guys, but I think that's pretty attractive. What are the risks you took here? You took a risk of not getting paid for the first 24 months, and you took a risk that the property would appreciate. Last 75 years or so of real estate in the United States, if you go look up the chart on the Fed, that chart just kind of heads up. Kind of like the stock market, on a long enough timeline, it only goes in one direction. All right. A couple expectations. When you're first position, typically the funds get wired to a title company on a new acquisition or even on a refinance. So if you're first position, you're writing the biggest check. Again, if it's a $100,000 house, it's $100,000 to do that loan. But typically we'll do that through a title company with title lender policy and all that stuff. For second position and preferred equity, most of the time you're going to be sending it straight to the borrower, no title company. You're going to be wiring that to the LLC that owns the property. You want to know when are payments being made and when are they starting? Even if we're doing monthly payments, right now, as of today, it's the 21st. If we did a loan today, do I owe you a payment on the 1st of next month? Or is that going to the month after? So you want to be clear about when are those things happening. How are you going to receive your payments? Like Joe mentioned, there's fees associated with certain things, but ACH, e-check, are we just going to mail you a check? What kind of magical way do you want it? You can have a wired too, and we have a wire fee every time. I can tell you that the majority of our payments are ACH. That's probably 90, 95, 98% of them. We ACH stuff. What docs are needed and when are you getting them? All right, this is going to vary a little bit by structure, but typically you're going to have at least draft documentation where everything is not signed, but it's all there, what the terms are and everything, before you'd wire the title. If you're going to be wiring directly to them, then you're going to want at least electronic scans of executed stuff, as in all the signatures are made, all the dates are on it, and the mortgage in, I believe, every state has to be notarized as well. So you'll need a copy of that. So digital copies are enough for us to wire funds, and then you'll need to receive the wet ink later. But you're going to want clarity on what docs are being received and when, who's holding them, right? Does your custodian hold your lender docs? Not typically. So you're gonna want to know what the specifics are on what the documentation is. What kind of reporting can you expect from your borrower, if any? I can tell you that if I'm making monthly payments, that's my report. That's the only report you're getting from me. You got paid. We don't need to talk. If we're doing something like a 2-year no payment thing, then we can discuss it, but we'll probably end up on a phone call once a quarter or so just to see what's up and how things are behaving, and so I didn't die and run off or anything like that. So we'll have some sort of reporting in there, but that you're going to want something you're going to want to negotiate with your borrower as well. What can they expect from you? Do you even want bothered with them? There's another question. The uncomfortable question that is totally worth asking at least once is, if this goes to shit, what's going to happen? How is a default going to work? And like I've mentioned a couple of times, a default is going to work pretty differently in every state. In the event that you're doing preferred equity, though, it's going to work about the same, which is just you take over the LLC and you're good to go. Okay. And while that sounds super, super simple, it'll be your retirement account taking over the LLC. So there's going to be some implications for your accountant, and what you're most likely going to do is list it with a local real estate agent and get rid of it in a fairly short amount of time, unless you really want to keep it, in which case you're going to need to learn all the magical rules of owning property in your retirement account. And then what happens when the loan ends? I can summarize this part for you guys pretty quickly. What happens when the loan ends or is about to end? Usually it means the property is either under contract to sell, or that I'm refinancing and you're getting kicked out of the deal and getting paid back. I'll call you up and I'll say, hey, this loan you have with us is going to come to an end. So I'm going to send you over a payoff letter, a satisfaction letter. And on that letter is exactly how much money we've calculated we owe you. And it's broken down as a per diem. How much do we owe you per day, depending on which day this actually closes. And you'll check my math and make sure I didn't screw up somewhere. And assuming you agree with it, you're going to have that signed and notarized, and you're going to return it to the title company, who's going to use that to then pay you off when either the property refinances or closes. Those funds have to go back into your retirement account. They can't go anywhere else. Where they came out of, they have to go back to. And all the proceeds need to go there as well. There's origination fees we can actually do somewhere else, but in general, all the money that comes out has to go back in, right where it came from. Okay, and that's how pretty much all of your loans will end when you guys do these. Then usually the follow-up question is, do you really want your money back, and are we going to do it again? Okay. All right, guys. There's a nice overview for you of mortgages.
Great
We have any
stuff.
questions today?
Great stuff, Brian. I've got a few. I'll kick it off, and hopefully we'll get some other people who are watching to chime in. First, that picture at the beginning of the samurai sword, is that what we can expect when we negotiate with you? That's how we'd end up.
Yeah, pretty much. Yeah, don't
Okay.
don't send leg breakers after me. It won't work. You're better off with lawyers.
Okay. Along the way, I didn't want to interrupt you because you're on a roll, but you can just, folks in our audience, you can combine qualified and non-qualified money to do this stuff.
Mhm.
Um, and when you do it inside of your IRA, it's pretty much the exact same process, except we're kind of CC'd on everything. You'll end up submitting a mortgage promissory note that's signed and notarized, a note acknowledgement, which is a simple form the borrower signs and checks a few boxes on. And then when the mortgage is recorded at the courthouse, we get copied on that. You maintain all the originals. If it is unsecured for any reason, then we house the originals here. There's a great checklist at our website if anybody wants it. If you go to our forms and docs at the website for doing these things, it pretty much leads you right through it. Plus, we'd have someone here that would walk you through it or help you through it live, so you don't get stuck out there trying to figure stuff out for yourself.
The one of the major functions of your custodian guys is they need to keep you away from the prohibited transactions. And they don't want you doing stuff that's like royally stupid. So the
Yeah.
making sure the paperwork is right, that so that your mortgages are recorded correctly and that kind of thing. There are some very robust laws around this type of investment.
Mm.
Um, if I agree to record a mortgage and you wire the money straight to me, and a year or so goes by, or even a couple of months, and that mortgage is not recorded at the county, then I've committed mortgage fraud. and that is a orange jumpsuit level felony.
Right.
So not one that anybody wants to mess with at all. So there's some very, very robust rules here designed to prevent outright fraud and that sort of thing. And it's not hard to follow these rules. Just get your paperwork right. And so Joe and his team, I'm sure, will keep you guys on the right side of the tracks with that.
We do. We review all of that stuff and make sure that you also want one other thing. If it's a piece of property, you want your name on the certificate of insurance and all that's in the
Yep.
checklist. And it's stuff that Brian's familiar with. And anyone who's done this knows the drill. Got a couple of questions. Paul is asking, what's the highest amount you work with and what is the lowest amount you work with?
Lowest amount I've worked with was $5,000. It's a kid of one of my lenders, and I took it as an unsecured loan, and we just keep his 5K and we pay him some interest on it. It's so the I think he's 9 gets a return. Okay, that's a favor, not a loan.
And you give him an update, do you?
No, actually, he gets a I think he gets an annual payment. It's it's
Okay.
a 5 year or something. So that's the smallest. Typically though, for real, about the smallest dollar amount we'd work with is probably about 25-30,000. Anything below that, it's really not even worth the paperwork. Given the size of assets we deal with. Largest dollar amount, largest private note I have is 6.2 million. So it's probably somewhere a little bit lower than that,
Wow.
the year
Wow.
average.
All right.
Uh,
Good question, Paul. And I hope that answers it. Jim, wanted just for you to recapitulate sort of a one sentence description of the preferred equity deal again. And I loved it. I've heard of it, but I've never had it
yep.
explained to me. This was really good. Jim wants a recap.
Yeah, so preferred equity is so the security on your loan, you're going to make a loan to an entity. An LLC is the most typical structure for this in the US. You're going to make a loan to an LLC, and you're going to receive some amount of equity in that LLC. It doesn't actually matter what the number is, 1%, 10%, whatever. You do specifically want it below 15. Otherwise, any bank they deal with will want to underwrite you too. So under a lower amount. And in the event of a default, instead of going through a foreclosure and trying to take the property back that way, you will take the rest of the equity in the LLC. So you'll become the 100% owner. Sometimes it flips. Like there's a version of it where we'd give you 10% ownership and we keep 90, and in the event of a default, it flips over. So now I own 10%, you own 90. But the essence of it is you gain majority control and can do whatever you want. And so it's an instantaneous foreclosure. It's possession, better than 9/10 of the law. So it's a very sexy way to go about this. Again, I tend to do them only on somewhat larger deals because in one LLC I'll have quite a few properties, not just one. I'm not going to have one house in there for you to do it with. But if we're talking about an entire portfolio, then yeah, we can totally do preferred equity structures on those.
All right, Jim, I hope that answers your question. And we're kind of closing in on the 1 hour mark, which is usually what we do here. If anyone has any questions, don't hesitate to send them to us. We'll push them over to Brian so that he can answer them, or you can follow up with him directly. I saw his contact information at the bottom of the screen. So feel free to get in touch. And again, this will be sent out to
Yep.
everybody. So there it is right there. So you'll have
And
a chance to go ahead,
yeah,
Brian.
I see a few other questions here. These are pretty quick. I can answer these. Does the lender have to provide an annual 1098 interest statement to the borrower? We give you a 1099 for the interest.
Okay. That's a
It's
good one.
every time.
Yep.
Yeah,
Yep.
that's real simple. Now you just take that and if when it's a retirement account, that 1099 does not harm you. You just record it accordingly. And then how do we solicit borrowers? This is more than anything else. This is a relationship game. And so what you're after, you'll find no shortage of people who want your money. It's about the easiest thing in the world to sell. What you're specifically looking for is competent people. Something I didn't have on my risk list there is somebody who's done less than 10 transactions. If they're new to this game, if they haven't done this lately, or the last time they did a transaction was before COVID, those things would all increase the risk, right? So uh, if you know the person, if you worked with them before, if they come recommended to you, those things are all going to help. And another thing is you can be referred to them, right? Uh, Finding people my size, I would say there's only one or two in every major city that are kind of your uh, BlackRock uses the term institutional to refer to investors who have more than 100 transactions in the last 2 years. And that's what I am, or Black Knight does that rather. So looking for people that size. The problem with dealing with people like that is we have more options. So I can afford to tell you, no, I don't need your money because I have lots of other people who would give it to me. Whereas if you're dealing with smaller individuals, you're probably the only game in town. So that's a form of risk reward too. It really comes down to networking and finding where your comfort level is with dealing with the investors who are going to be operating those investments.
That's so true. Get out there and network. People are always asking us, where do I find deals? How do I get a hold of people who are willing to borrow or lend money? Um, you got to get out there, join the real estate groups, get in the diversified investor groups. There are dozens of groups just within a 20-mile radius of this office, and I spend a lot of time with them. And they're a great resource because you'll run into people that you can get to know over a period of time and build a level of trust with. And they're also a great resource because people in that room have been through it all before, and they've probably made a lot of mistakes that they're willing to share, do's and don'ts with you. So, and that's a part of the due diligence process. Talk to people that you trust, who work with people that they trust.
A really good question is for a more experienced investor is tell me about a time you lost money.
Mm,
And if they don't have an answer to that, then I would consider that a red flag.
yeah,
And now I don't care. I've lost tons of money, guys. My lenders have not.
it happens.
Yeah, and that's
Yeah,
that's that's the answer you want to hear. I got eaten alive on a couple of deals. You get, it goes to shit. That is a thing that happens. Did I make all my lenders whole? Yes. Yes, I did. And that's the answer you're really looking for underneath. What happened to the lender on that deal? Did they get left holding the bag or were they able to make it right?
yeah, and that's when the character gets tested. 2008, during that time period. Right now, is interest rates are affecting a lot of, particularly the fund guys. How they
Mhm.
perform under stress and duress, and how they make people whole is a big tell. And you can go through that with them and end up with lifelong relationships, investor relationships with them. So
100%.
I would get out there and meet people. Um, Everyone's got the contact information. You know where we are at Camaplan. And we're willing to help on any of this. It's a very easy process to do this inside of your IRA or 401k, and we're happy to help. Anyway, I'd like to thank Brian for coming in today and or coming in remotely and visiting with us and sharing great presentation. Looking forward to seeing the slides again myself.
Thank you.
All right, everyone else, take care. Thanks, Jim and Paul. Thanks for your questions. They were excellent. And everyone take care and have a great rest of the day. Bye-bye.
Bye bye, everybody.